Folks, welcome to the Contrarian Trader. Tonight is Wednesday, the 23rd. Apple has reported earnings and was annihilated after hours. And I remember last evening, I was watching CNBC, and I just want to play a snippet for you. So just please take a moment and listen to this. It just points out the hypocrisy, which is what caused me to start the Contrarian Trader a number of years ago. And just bear with me, just check out this clip.
With an earnings analysis, Rocco, you say do not buy Apple ahead of these earnings, and yet you are a short-term bull. Reconcile that for me.
Yeah, that's a good question. It's a fair question. I think that, unfortunately, the investors will not, or traders, I should say, should be in this stock. I'm saying go in it. You know, if you guys are nimble like the people on the panel here and you can get in and out of the stock and protect yourself properly, do it. Most people can't do that, though. So as much as I think they might blow it out tomorrow, anything can happen. I don't think long-term investors need to be in such an anxiety-ridden stock that's driven by headlines, that has unrealistic expectations right now, when there are so many other names to be in over the last year and probably going forward that can give you a better return and also help you sleep at night a little bit better.
But Rocco, if you're a long-term investor, you're not focused on headlines. You're not focused on the noise. You're owning a great company at a good valuation that's going to make a lot of money.
Exactly, and it depends on where you are right now with your position. Everyone's going to be different. When did you buy? Have you taken any profits yet? Everyone's going to come into this differently. What I'm saying is don't go in tomorrow before earnings and buy the stock to start a new position or think you're buying on a dip. I don't think that makes any sense, because even if they blow it out, okay, even if they do over 50 million iPhones for the quarter, and it looks like they might based on Verizon's numbers this morning, it doesn't mean the stock's going to go up right now. So why get into that and worry yourself at all? If this thing takes off, if it becomes the darling of Wall Street again, if there's a bunch of upside to be had, you'll have time to get in when all this noise and hysteria blows over. So if you're an investor, why bother?
Okay, I'm going to get back to this interview in a moment, but I just want to make a point. The question I pose is what is wrong with what Rocco Pandaro said? What was wrong with it? It makes sense. If you're a new investor, I tell my members this all the time. If you're new to the markets in particular, why would you go into this trade the day before earnings and open up a position of, let's say, 100 shares? Why would you do that? Why not wait until earnings settle out if you have the ability to read a chart? This is not where you want to open up your position, especially with a stock that has been breaking down and where it closed on Wednesday afternoon was nowhere near the upper band of the declining downtrend line. This stock has been hanging on for dear life to close above $500 per share. Why would you make this trade? Unless, of course, you're a seasoned investor, like a Tim Seymour, who could have entered this trade, and if he was smart, he would have bought some front-month put options to hedge his position. But why would you do that as a new investor? And I believe that that's what Rocco was trying to say. However, they took this guy to the woodshed, and let's get back to the interview really quick.
It's Karen.
It's Karen. I got to ask you something. So if you're a long-term investor who already owns it, should you sell it before tomorrow and then buy it back later?
That's what it sounds like
you're saying, which doesn't make any sense to me.
It depends on your situation. Everyone's different. Everyone's going to have a different cost basis. When did you buy Apple? Did you buy it 5 years ago? Did you buy it last year?
It's never relevant.
Okay. Why is the cost basis never relevant? I find that statement to be completely absurd. If you have a cost basis of, say, $197.50 per share, you bought at the bottom right here, and you rallied this stock higher, and you're not a chartist, and you didn't realize that the stock is now broken. It broke the lower band of its rising uptrend channel. But let's say, hypothetically, you're a fundamental trader, or you're a fundamental investor, and you really don't care about this. You still have a huge gain in this stock. from $197.50 to, say, $500 per share. Now, if you were to give up, like Apple did after hours, it closed down over 50 points on the day. In the after hours session, you're still up a huge amount of money. So why doesn't a cost basis matter? I'll tell you what it matters. And this is what screws the little guy every single time, and this is what I pound the table on. These talking heads continually pound the table with a bullish tone on the stock market to get the little guy excited. And what will they do? They'll listen to Tim Seymour last night and Karen Finerman, who are good people. However, they excite the little guy saying the cost basis doesn't matter. Well, guess what? If you bought 100 shares at the open this morning, being Wednesday morning, you're down roughly $5,000 on your position. Now, if you're a new investor, what are you going to do? Are you going to be shell-shocked? Are you going to dump your shares on Thursday morning when you really should have been buying and then get scared away from the market? This is why the average investor doesn't trade the stock market anymore. So the basis cost doesn't matter. It's relative. It's relative to your situation. If you had been properly scaling out of your trade and you opened up this trade at 197 with 100 shares and you took 25 shares off here, 25 shares off here, 25 shares off here, and boom. Okay, you know what? I still make it. I'm down big today on the stock, but I still made a heck of a lot of money on this stock. So you're not going to be scared away from the market. However, if you listen to the cavalier advice that was being given now on Fast Money on Tuesday night, well, you could have been stuck with a big loss in the after hours today. And that's not right. It's just simply not right. So I disagree with their statements that cost basis doesn't matter. It's a relative term. Were I a new investor and I was down $5,000, you know what? That cost basis matters a hell of a lot to me. If I've been in the stock from here, 197.50, I've been scaling out. Well, I took a hit after hours, but you know what? I still made a hell of a lot of money. So my cost basis doesn't matter as much. It's all relative to when you enter your position. And to buy a stock in advance of earnings is speculation. And if you want to take the argument of the stock is trading with a PE of 11.64, I would ask the question, why? Why is it trading such a low multiple? Doesn't anybody find that concerning? Isn't that the market telling you something? I digress. Let's get back to that interview. Because this will show how some people talk their book.
I want to get the bottom line here, Rocco, on what you're saying. So you're saying longer term you're concerned about Apple's prospects, but you're saying if you're a long-term investor, you should what? Own Apple or not own Apple?
The bottom line is this, Melissa. It's a great stock to own long term. It's not a great stock to get into, to start a new position in right now, because all of the noise and all of the headlines that drives what happens in this thing.
Is it priced fairly? Is there an attractive value proposition? I mean, these are the things you should be thinking about, not whether the psychology.
Absolutely.
Okay, let's get back to that attractive value proposition. This Tim Seymour's got me so ticked off right now. Attractive value proposition to me is 11.64 on a stock that's a cash machine. So yeah, is there a value proposition there, Tim? Sure there is. But guess what? That stock after hours today is trading at a hell of a lot lower price. Why? Because they disappointed. How do you know the value proposition until after earnings are announced? Maybe that value proposition isn't all that good. Let's get back to the tape.
Absolutely, it's priced fairly. I mean, it's not priced fairly. If you take a look at Amazon, we give Amazon the benefit of the doubt with a 3,000 PE, and I'm fine with that because I think Amazon's going to execute its long-term plan really well. And we don't give Apple even close to the same type of benefit of the doubt. I mean, absolutely, it should have a higher valuation. But again, I don't know if any of this really matters. I don't think people should be in this stock right now.
We got to run, Rocco.
Okay, fair enough.
Thank you, Rocco Pendola of TheStreet.com. Okay, I want to address one thing because, I mean, cost basis.
I don't believe cost basis matters at all.
Every day you own.
Every day you own is a new, but for your consideration about taxes.
Yeah, or, you know,
long-term.
How ridiculous.
It's certainly, to me, a case where I get what he's saying is that Apple is, first of all, the street was upgrading it at the top. They're downgrading it, what a lot of people think is at least a short-term bottom, and you have to, weed through the merits of the investment process. This is a very interesting time to do that, though, because, again, you've got a company that's going to show probably record earnings tomorrow and a stock that's been beaten up. So this is a stock I own for a trade, and I think Apple has some very good days ahead of it, and I think that at least in the short run, the stock can go to 550.
The stock is not. What did it close tonight? Closed at 463.49. A $50.52 drop, or nearly 10% after hours. Now, this guy Tim Seymour is not a dumb guy. What I would like to know, and maybe he addressed it tonight. I don't know. I'll give him the benefit of the doubt. I didn't watch Fast Money this evening. Was he hedged? Did he take profits today? I guess not. If he thought it was going to go to 550, is he going to stop out tomorrow? These are the questions I would like answered now. That would add value to me as a viewer. Now, okay, how would I have handled this trade? If I wanted to speculate that Apple was going to rally on earnings, first off, I wouldn't have bought the common shares. I would have bought some front month contracts, call contracts, and traded it that way because it's speculation. Because the stock right now is trading in a pennant formation. But before we get to the daily chart, you really need to take a look at what it looks like on a weekly chart. The stock is broken. And we know for a fact that it's been barely able to hang on to 500. So I'm not going to expose myself to the common shares. I would rather just simply buy some front month contracts, call contracts, and trade it that way. So let's assume that the stock was still in an uptrend. The stock made a pullback. How would I trade this? It would certainly not be with the common stock. It would be with options. But if I didn't want to trade it ahead of earnings, what would I do? I would have just said exactly what Rocco said. I just don't think he was articulate in the way he said it necessarily because they started ganging up on him. I think he was right in his overall opinion. But the proper way to have traded this, and this is what Rocco should have said, was allow the stock to rally, assuming that it was going to come out with good news on earnings, which it did not. Allow it to rally. Test this upper band of the declining downtrend channel. Does it close above that band? Even if it spikes up to 550, allow it to pull back. The probability of it coming back to retest the upper band here to see whether or not that will now be support rather than resistance is very likely. So why not wait? Let the froth simmer down a bit, let it pull back, see if this is good support, or will it be a breakout point failure, close back down below the upper band of the declining downtrend line, and you'd be glad you didn't get involved with the stock to begin with. So that's the problem here. I think there's not enough emphasis on these programs placed on the technical analysis, the proper entry points, and the proper ways to protect yourself if you want to speculate. There's nothing wrong with that. But I just think it was wrong what they did with this guy, taking him out to the woodshed. Generally they don't do that. I think that what they did was wrong. I think Tim was somewhat talking his book. Karen got on a high horse, and I think they were wrong for doing it. Folks, if you like this video, please like it on Facebook. If you're watching this on YouTube, please subscribe to my channel, leave a comment, and I will definitely get back to you. And that's it, folks. Have a great, great evening. If you have any questions, please shoot me an email, and I will be doing another video tonight on skull candy. And talk to you soon. Bye-bye.